Hello and welcome to the Harwood Report for July 23rd, 2018. I am Keith Harwood, the host of the Harwood Report and the founder of Trade Academy. As a reminder, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Okay, you read the disclosures. This week's highlights, I'm just doing the same sort of stuff here. I'm going through the macro, guys. It's getting interesting. Let's not spend too much time looking at the list and start looking at what's going on. First off, fear and greed shows neutral. It's pretty clear in the market that that's what's going on. The one thing that's showing a little bit of fear is put-call options. So it looks like people are trying to hedge. Some of that may be coming out of the market the day as the market's kind of was weak this morning. It's bouncing back, and the VIX is starting to get hit. So let's look straight at the charts. Let's look at the daily here. Sorry, I was on the 15-minute there. S&P 500 tested the 10-day moving average and bounced. It's really been sort of sitting here. It's a very small bull flag maybe setting up here. If we can get above Friday's high or tomorrow get above today's high, that sets up really bullish. If we look at the volatility for S&Ps, it's going slow for me. There we go. You can see that it's near the lows here. The other way to look at it is frankly just through the VIX. The macro equity indices all look very similar here. We had a little bit of a bid as people start preparing for earnings season. Seems like that's starting to come out of the market. And as those earnings get announced, that vol premium comes out. That naturally puts a bid to the market as the VIX gets hit. I think that's kind of what we're getting into here. We're getting some big tech earnings out this week and next. Facebook this week. I believe Apple's next week. You just got a lot of stuff coming out this week and next. As that stuff comes out, that should help create a little bit more support for the market. And I get that people are worried about trade fears and trade rhetoric, but I just don't see anything really shifting there to be cataclysmic in the near term. There was a little bit of concern about what was going on with Chinese currency, and yet the market didn't fall out of bed. So maybe that means we just need to kind of put that on the back burner, knowing that at the end of the day, they probably figure this stuff out. If it takes a long time, that could have an impact on the economy. Let's listen in on our earnings, though. That's where the key is. People will guide earnings based upon expectations of trade. And as those companies guide, if they're all guiding lower, the market will get hit and it'll tell us it's time to, actually worry about this. If they continue to guide higher and perform well, at the end of the day, it tells us that everything's still okay in this economy and we can still invest in equities. I talk about how I'm looking at actually trading these with the options in the premium newsletter. Today I'm just going to focus more on the technicals and kind of the volatility setups here. IWM, I think, is crucial here because this is the one that is creating this nice ascending triangle. You can see we've basically tested the highs twice. The rule of thumb that I was always taught is that double tops and double bottoms often hold, but triple tops and triple bottoms rarely do. Well, 1, 2, if we test that again, I can see IWM skyrocketing, especially since it's trading at a decent discount to the Qs. So you can see the Qs are trading about 180. Well, IWM and the Qs have traded close to parity in months past in terms of price differential. So there's a lot of upside there potentially for IWM. I think that's got a more exciting setup than any of them right now. The Qs have broken out already this year, and they're still trading above basically all highs except for what was made last week. Good earnings is going to launch the Qs. I'm not saying the Qs are bearish, but gosh, how can small caps continue to underperform when that's the safest sector if we're looking for anything, because it's mostly domestic. So I like the way that the IWM is setting up. I like the way the vol in IWM is setting up. Again, IWM vol often trades parity with Q's vol, and it's 3 points lower. So this is about as low as it's been in 6 months. If I go out a year, the lowest really we saw in the Q's was about 10, only for a couple of days there. It's basically an 11.5 to 12 vol product on the lows before everything that happened in February. We're basically there. IWM has the leverage for me. Let's go to the other stuff. TLT. I've been talking about that as a bearish setup here for, from last week. And it just fell out of bed Friday and fell out of bed again today. I don't see that much more downside here. Maybe down to 118.5. Just basically into this consolidation area. There's an outside chance we get down to 116.5 here. I don't know that this is going to break down through that level. The other issue I got with TLT right now is the vol is not friendly. So Look at this, where the vol is right now. It's basically at the upper end of the range. It hasn't proven to me that it's going to consolidate yet, so I don't want to do something that's deleveraged like an iron condor or a butterfly. I don't see a lot of leverage out of this if I'm paying the highest vol we've had, especially if I think that the market may slow down a little bit here. So for me, this is actually a no trade setup. I don't necessarily need to do anything. So I'm going to let that guy go for the week and focus on the other stuff that tends to be hit by these global macro things. So the equity indices I already discussed. Let's go to dollar yen, because what's going on there is a little bit of a shift. Again, on Friday, dollar got hit hard. It got hit a little bit more today and started bouncing back, but it looks like this dollar yen top may be in for now. So what does that do? That should give me a bullish bias in gold, especially when gold has now tested the low and looks ready to kind of bounce off of it. Just notice what we did last time. We got down here, a little bounce, and then bam, just skyrocket after that. I could see something like that happening again. 121, not out of the question. Now, do I think that there's greater likelihood of vol coming off into a rally? Yeah, and then a move towards 119 where there may be a little bit of trade here. I think that that's where we could see the vol get hit, especially since GLD vol is just at, it's like TLT vol. It's near its highs here. Same sort of setup with SLV. SLV vol is at its highs. So that's set up a little bit better for like a call butterfly into the bounce, and then looking for more leverage once I see vol get down below 10% in GLD and below 16 in SLV. So back below 10, a little bit easier to go long. If I go to the minors, you can actually see, though, this vol never really got there. So why didn't that get a bid? Well, you can see it in the move. So gold and silver collapsed down to these kind of lows, and gold miners just didn't get there. They pulled back to this consolidation area and never followed through. So what do I think about that then? Well, if dollar yen starts to bounce back and firm, I think we could see some capitulation out of these gold miner longs. We're getting close to that low end right here. I don't necessarily need to play for the bull side. There's a couple bucks of upside, 33.5, 34. But can we really get there without gold firming first? Probably not. Maybe. I don't know for sure, but I just feel like the gold move has to happen before the miners are going to really bounce back to 33, 34. So even though that falls low, it's just something that goes on my watch list as a result. Okay? So that's how I look at it from the miner perspective. Now let's go to oil. So first things first, oil got hit, as we know. Okay, but then it started coming back today off of the Iranian comments. Then it pulled all the way back and basically is actually down on the day now. It's not a great sign for the oil names if oil is starting to weaken again. So when I go to XLE, the thing I want to see is firmer oil so I can see this get that move back to 79.5, 80 bucks. If oil continues to weaken, there's a chance this goes down to 67, 67.5. Where's vol at on XLE? That's probably where my edge is. Because look at this vol. It's down about as cheap as it gets. The red line is the implied volatility level, and this is about as low as it gets. So I think the edge here is in vol more so than in price for now in the oil names. And OIH as well. OIH you can see is weaker than XLE, and it's actually kind of approaching that consolidation area. 24 and a quarter-ish. 24 maybe. So there's a little more potential for movement here. I'd like to see oil firm so that I could get the real leverage on the upside, but for now maybe the play here is just a vol play. And again, let's look at the OIH vol, and you can just sort of see, even though it's up about 1.5% today, it touched 26 on Friday. It's about as low as it gets. Up a little today, just because of the move. We got a 2% move. That's, a 26 vol is implying closer to about a 1.5% daily move. So we're moving a little bit more than the market was priced in for. But I think that there's still an edge there because the vol is generally kind of low, and it could easily get into the 30s if we keep moving like this. So that's how I'm looking at these things. And so I kind of structure my trades on a vol basis for the oil sector right now, more so than on a directional basis. But I got that directional bias, I think, in the equity market, and potentially in gold and silver if that dollar yen continues to weaken. All right, so I talked about the Harwood Report that I do, the newsletter. I've already posted it. I talk through the actual trade structures that I'm looking at there. So if you want information on sort of how I actually then structure the trade, given everything I've just talked about, that's where you can get it. You can get the first 2 weeks for free. It's $49 a month after that, and that $49 price point is going to be changing. So be aware. I'm going to give it one more week at 49 bucks. Next Monday or Tuesday, maybe I'll give you guys one extra day on it after the report next week. But we're not talking about long. I haven't decided yet. It might be Monday, might be Tuesday that I change this price up. So if you want to get in and keep your price at 49 bucks and get 2 weeks for free, you sign up right now. That seems like a no-brainer to get the first 2 weeks for free, then have the option to buy it for 49 when the price is going to go higher than that. If you have any questions, you can email me, keith@tradeacademy.co, or call me 312-600-8004 with questions or comments. Thanks again, everybody, and we'll talk. Hopefully you'll see you all on the newsletter today and the Wednesday update that I'll be sending out for members only on Wednesday, and if not, next week. Have a good afternoon.